The Q4 RICS global surveys have now been released, capturing feedback from over 6,000 professionals working in the construction and commercial real estate industries. The headline numbers suggest that the construction sector at a global level remains fairly resilient in the face of rising interest rates and the related macro headwinds. By way of contrast, there is a little bit more evidence of strains when it comes to commercial real estate, particularly on pricing, with higher borrowing costs proving a challenge in some of the more expensive markets. Significantly, at a regional level, the feedback to both surveys is notably more upbeat in parts of the Middle East and also, for that matter, Africa. I would point in particular to Saudi Arabia and the United Arab Emirates, as well as Nigeria, where the insights we have received are indicative of strong growth in construction, as well as a firm trend in real estate, and that's both from an investor and occupier perspective. Now, robust economic performances are, to a greater or lesser extent, underpinning these trends, and let me give you one example. It's likely that the Saudi economy grew by around 8% last year, which provides a pretty good background for construction and indeed real estate. The picture in APAC is a little bit more mixed, with China and Hong Kong still recording negative results, despite the ending of lockdown and the introduction of a number of supportive policy initiatives. That said, we would expect these measures to feed through in due course, and do anticipate the data will reflect this as we move through the course of the year. However, the contrast across this region is provided by the likes of India and Singapore, and there are a few other countries that also fit into this category, where the story is much more buoyant, according to contributors. Indeed, the headline construction activity index is particularly firm in India. The metrics for North America are predictably a little softer than in Q3, certainly when it comes to commercial real estate. But interestingly, the construction sector in aggregate still appears to be holding up in terms of the feedback that we've received, despite increasing pressure on the residential market. Meanwhile, Europe is pretty much the softest region in both surveys, reflecting in part the bigger impact of higher energy costs on both the economy and indeed inflation. And just a bit more about Europe. Within the continent, the feedback from Germany is particularly downbeat, while in the UK, it's a little bit more nuanced. Critically, when it comes to disaggregating the construction data at a sector level, there's one area of activity that is pretty much a standout, and that is infrastructure. That is the area where the momentum of the workload still remains very firm, and that's the case pretty much everywhere around the globe. Importantly, this is projected to continue through the course of 2023, helped in part by a number of post-COVID spending commitments by governments. The residential development outlook is a little bit more clouded, with build-out rates likely to slow in those economies where house prices are under greater pressure. An ongoing issue for the construction industry is the cost of building, with material prices, as we're all familiar with, still at elevated levels, and labour shortages persisting in many countries. Despite this, away from Europe, the expectation of respondents to the survey is that profit margins will either stabilise or continue to grow, and that's particularly the case in parts of the Middle East and Africa, and also in some APAC markets. In terms of real estate, there clearly remains a solid appetite for alternative assets, including anything to do with data, as well as aged care and student housing, if the responses from RICS members is anything to go by. Alongside this, well-located logistics sites are still very much in demand, with prime offices also having attractions, particularly those with high specs on sustainability and well-being. But unsurprisingly, perhaps, the feedback around much secondary office space and indeed retail space is pretty negative. That said, price adjustments looking forward are generally seen as being pretty modest in a historical context, even in the weaker segments of the real estate market. And to finish off, Tentative signs that the global interest rate cycle may be close to peaking as headline inflation rates begin to soften, albeit only modestly so far, does provide some further reason for encouragement.